In this video, traders, we're going to look at 9 tips for trading on margin. Stay tuned. Hey traders and investors, a very warm welcome to you. So trading on margin is basically utilizing other people's money, in specifically the broker's money, to leverage up your position size on positions you're taking. So you get more kind of bang for your buck. You only have to put up a percentage of what you are trading. £100,000 position, you might only have to put up £20,000, £10,000 or £1,000 depending on what instrument you're trading. So you can get far more gain for the money that you have, and also you can lose far more. So from an investing perspective, how do we use it and what are the tips for using it? By the way, if you want to dig into margin, I've done another video actually on margin, all the fundamental details of it, but these are 9 tips for actually trading on margin. So if you know what margin is all about, 9 ideas for getting better results from actually using it. So number 1, know the interest rate. People forget, hey, you know, it's a loan. It's basically a loan. While you're using it, you are being charged an interest fee, interest rate for using it. That could be 10% per year. It's going to depend on the stock that you're trading, potentially, depend on the asset you're trading, the broker you're trading with, all that kind of stuff. So know how much you're being charged. That's going to depend, and that's going to affect, should I say, how long you want to hold the position. Do you want to hold the position for a year? In which case, if you're being charged 10% to hold that position, and it's normally accrued daily, so it's 10 divided by 365, and they bill you daily for holding it every position overnight, however much margin you're using. If you plan on holding that thing for a year and it's 10%, you've got to make at least 10% in that gain in the asset just to break even. So it might not be the right thing for you. If you're holding it for a couple of weeks, you can probably say, hey, I'm in a volatile stock, it's moving around 20-30% in that period of time. I'm trading it from a swing trading perspective. I'm all good. So just understanding how much you're paying, because it kind of creeps up on you because you get billed every night for it, just removes it from your account, and it's relatively small. You don't notice it unless you've got a lot of positions and you've got a high margin, and then every night you kind of get billed, you get billed, you get billed, then it becomes meaningful. So it's a useful tool in that respect, but just being mindful of what your interest rate is. Number 2, buy over time, not in one go. Because you're buying on margin and you're dialing up really the sensitivity of your entry. So you've got to be very, very careful about how you enter. So one tip and one way of doing it is to scale into the position over a period of time, as opposed to just whacking it all on one go. And then if you're wrong and you try to draw down 10%, if you're on margin, that might end up being 40%. And that suddenly becomes very, very painful. If you're scaling in and utilizing margin as a tool to build a bigger position over a longer period of time, over a variety of price, that dampens the effect that you're getting from the margin. Now, of course, if it goes your way, you kind of think, oh, I wish I'd have bought all in one go. You've got to have the rough with the smooth. You've got to say, well, okay, I may end up paying a higher price, but because I'm spreading my risk over time and over a certain period, I'm kind of mitigating the fact that it could go against me straight away. All right, number 3, know the rules. This is kind of from a perspective of, if you're trading in the US, you're trading in the UK, trading wherever you are, people have got different rules. In the US, you've got the pattern day trader rule, and in the UK, you've got rules depending on how your margin is treated, whether you're going to get liquidated, what drawdown percentage you get liquidated at, when you get a margin call, go to a margin call in a second, how much you've got to pay, how much you've got to receive, all the kinds of, there's different rules depending on which country you're trading in and which broker you're trading. So just understand the rules of the game, especially when things don't go as well as planned, because that's really when, as we know with life, like terms and conditions come into play when things don't quite pan out as they should. So if you get a margin call, what gets liquidated first, what doesn't, how you can avoid it, how much the charges are, this, that, and the other. Pattern day trading rule, what happens if you go over it, what happens if you do this, what happens if you do this, just understanding the rules of the game. It's very easy to go in and say, I've got margin, yeah, great, and I've got 200 grams worth of buying power, off we go, let's make some trades, make some money. Just take a few moments just to understand what kind of venue you're playing in. And 4, avoiding margin calls. You should avoid margin calls at all costs, guys. This is kind of a situation where if the broker is ringing you, and also it comes from the time when the broker would ring you and say, hey, you know, Mr. Smith, we need you to deposit more money because the position you've got is going against you, and to hold the position, you need to deposit more funds. And you go, okay, yes, I'll wire them over now. It doesn't happen like that anymore. Rarely it does. Generally what happens is you get an automated margin call from your broker that says, hey, you need to deposit more funds or we're going to cut the position. If you don't deposit funds, they cut the position. The point is why you want to avoid this is you want to be in full charge of when you're cutting the position. And if you're getting a margin call, it means that you're ultimately way too much leverage. You don't need to be that much. If you're getting a margin call, you're relying on the broker to take you out of a position. And by the way, if you're leveraged excessively and the price gaps against you, you will owe the broker money, because you have leveraged up so much and they haven't had a chance to give you a margin call. Let's say if you're in a currency pair and it's drifting down, they'll give you a margin call, they'll close a position. If you're in a stock that suddenly gaps lower 25% and you've dialed up on margin, you could have lost all your deposit and some of the broker's money, in which case that broker will most likely be ringing you and saying, hey, Mr. Smith, we need some money because you've got a loss, we've cut the position, you owe us 25 grand, or whatever the case may be. So just avoid their margin calls and don't really see them as a safety net. A lot of people kind of use them as a safety net. I think that's a real bad idea. All right, number 5, using stops. If you're investing, you might not be using stops at all. You might be saying, okay, I'm just investing 10 grand in this, 20 grand, 100 grand in this stock and letting it run. When you're using margin, you've got to be a bit more mindful, and you've got to kind of add an extra layer into the trade idea. In other words, where do I not want to own this stock anymore? Is it down 50%? Is it down 10% from where I bought it? 20%? Where is it? What's the number? Is it a finite number? Is it a percentage retracement? Whatever that may be, and then working that into your position size and saying, hey, am I comfortable with a 20k loss? Yes, okay. Take the investment. Am I not? Okay, I need to reduce my position size. Maybe I don't want to take it on margin actually, because this thing's an all or nothing. I've got a basket of 10 stocks that they're either all going to make money, or they're going to be 10 times the return, or they're going to lose money. So in which case margin isn't the right tool for you. So understanding, you know, the consequences of using margin, and if you're doing it, recognizing that you're probably going to have to use stops, because otherwise if all your portfolio goes lower and you're on margin, you're going to end up losing some money that you don't have potentially. Number 6, being cautious of news. Obviously being more geared up, being more leveraged makes it more sensitive, your portfolio more sensitive to swings in monetary terms. So if you've got a stock that's gapping on news, or you've got a whole market that's gapping on news up or down, that's going to have a significant gain on your portfolio, because you've magnified the effect of your buying power by however many times you've got margin. So 4 times margin, 5 times, whatever it may be. All of a sudden that kind of 10% swing in portfolio, or 4% swing in portfolio, means 40% for your deposit or for your portfolio value. So just be mindful of that, guys. Again, this kind of run along the theme of sensitivity, being more sensitive to significant market moves, because you've got that leverage dialed up. Number 7, keeping a cash reserve. It's important if you're trading on margin not to kind of put everything in, because as we just repeating here is, because the sensitivity is dialed up so much, you've got so much on 1 or 2 trades or a portfolio of trades, you've kind of got the amplitude really cranked up. You need that cash reserve so that, hey, if you're going to trade on margin, it doesn't really matter. If something goes wrong, you've got the cash reserve that you can either use for other stocks, you can use for whatever it needs to be, but having all your money in it's really considered a high risk thing to be trading on margin. And so it can be part of a portfolio of strategies. So I guess the point here is having some cash reserve with another strategy means that if it doesn't go quite as you plan on margin, you lose everything, which is very feasible when you're trading aggressively on margin, you've not wiped yourself out. Number 8, don't think of it as extra money. It's very easy to think, hey, you know what, I've got all this buying power, I've got £1 million worth of buying power. Hey, great, let's go crazy. It needs to be used as a tool. The capital you are given in a margin perspective is a tool only. It's not your money, obviously. All it allows you to do is increase the volatility of your actual cash you have on deposit. You've got 10 grand on deposit, it allows it to increase by 10 times, 5 times, whatever the margin may be. So don't think of it as extra cash, even though it might say buying power of X. Don't think of it like that. Think of it literally as a tool to use when the right opportunity presents itself, and you want to kind of go, you know what, I want to really be aggressive on this. I've got a stop loss here. I know that's a good place to have a stop. I don't want to just put my cash in. I want to dial up the leverage. I want to get the most out of this, and I'm prepared to risk more because of the margin, because it's a better trade or a better investment. Number 9, stick to your plan. Biggest thing, guys, biggest players out there, investors, traders, sticking to their plan. Very easy when you're trading on margin for the emotions to be tweaked, because the sensitivity, like we said, the money is really increased. Small swings equals big swings in equity. Big swings in equity equals emotional swings, which equal generally bad decisions. Okay, guys, 9 tips for trading on margin. Thanks for watching. See you in the next one. Take care. Bye-bye.